Hi there, my name is Patrick Kamure. Welcome to today's lesson of public finance and taxation. Just to remind you on what we covered last time, we did the turnover tax, and where we talked about the turnover tax being the tax that is imposed on small and medium enterprise, whose turnover was between 1 million to 50 million. That was before 1st July 2023. After 1st July 2023, we say that it was between 1 million to 25 million. That is per annum. And the tax rate, which we saw was supposed to be 1% before 1st July 2023, and then after 1st July 2023, it was raised to 3%. Now, it was worth also mentioning that there was something called minimum tax. Now, minimum tax had been introduced by the government in the finance bill of 30th June 2020, and it was supposed to be, it became effective on 1st of July 2021. However, when it became effective, some traders, business people, rushed to the court, and when they rushed to the court, they wanted that tax being declared unconstitutional, of which case the case was heard. Immediately after the case was launched, it was suspended. It was suspended by the judge, that is Judge Odunga, and now came September 2021, it was declared unconstitutional, and so it became effective. So it is no longer effective. So as I record this, which I'm doing in October of 2023, that tax is not effective. So in this case, if you find somewhere about minimum tax, know that it's not effective for now, as at October of 2023. Thank you very much. Now we continue with today's lesson, where now today we want to do the capital gain tax. So we need to ask ourselves, what is this capital gain tax? It's good to know that capital gain tax is the tax that is imposed on transfer of property. Transfer of property. In which case, when we talk of the property, as per the way it is defined by the Act, it is supposed to be 3 items: land, buildings, and unquoted shares. Unquoted shares, those are shares which are not quoted in the stock exchange market, like in this case in Kenya, Nairobi Stock Exchange market. So if you transfer those shares, then you should be able to pay capital gain tax if you make a gain. So land, building, and unquoted shares. So I want to write that one here, and as I do that, it's also good to know that capital gain tax was charged first at the rate of 5%. That was up to 31st December 2022. Now, come 1st of January 2023, the rate was increased to 15% on capital gain, in which case we want to see how do you get the capital gain, the one that you charge the tax at those rates I have talked about, then you get the capital gain tax. So I'll write something about it, that capital gain tax is imposed on transfer of property. Property as per Income Tax Act. Include land, buildings, and unquoted shares. Another point is that capital gain tax is imposed on capital gain at the rate of 5% up to 31st of December 2022. From 1st of January 2023, it was raised to 15%. Another point is that capital gain tax is payable. I had not mentioned earlier on is that capital gain tax is payable and returns filed by 20th of the following month after the month of the transfer of property, where a person filled a form called CGT1 while filing the returns. So now we need to ask ourselves, how do we get the capital gain? We have said that capital gain tax is charged on capital gain. So how do you get the capital gain that is chargeable, the capital gain tax? So another point, capital gain which is chargeable, capital gain tax is determined as follows. Capital gain is equals to transfer value minus adjusted costs. Where transfer this, that to get the gain, the one that we charge tax at the rates we have talked about, either 5% or 15%, you take the transfer value of the property and you minus the adjusted cost. How do you get the transfer value? Transfer value is the selling price of the property, the amount you get when you sell the property. You minus expenses relating to selling. That when you are selling, you may incur expenses like advertising, brokerage fee. Remove them from the selling price you have collected. You get the transfer value. Then the adjusted cost of the property, you take the purchase cost. You could have purchased land. And then once you purchase land, the cost of purchase you put here, you add construction cost. You could have constructed a building on that land and that construction cost of the building. And then you add expenses incurred while and or after purchasing. While you are purchasing, you may incur title processing fees, stamp duty, and during the existence of the hotel business, the buildings had been allowed investment deduction amounting to 740,000. The capital gain tax rate during the year was 5%. So we are required to compute the capital gain tax, CGT, if the any by Shebe Abdara on disposed property. And citing reasons, identify which of the following forms Shebe would use to file the returns in transaction in the one above. So we want to first of all to compute the capital gain tax. So first we had said to get the capital gain, you take the transfer value minus adjusted cost. So we need to get the transfer value, which you said you take the transfer value to be the selling price minus expenses incurred while selling. So we'll come here. We start with the transfer value. Transfer value, which is going to be, we take the selling price, then we ask ourselves, how much did he dispose the building? So in this case, we are told, almost in the middle of the sentence, he put up the building was completed, a local politician laid claim. We are told that it is actually in the first paragraph. Shebe Abdal disposed the property in September 2022 for 18,500,000. So that is 18,500,000. Then we said you minus expenses relating to selling, so less expenses relating to selling. Expenses relating to selling. So which expenses did he incur when he was selling? In this case, we are told to us, before the additional information, the following costs were incurred to dispose of the product, which we have valuation. So we have valuation. So those are the ones relating to disposing, which we have 247,000. We deduct. The other one is advertisement. Advertisement, which you have 52,000. The other one is commission. Commission to agents, which we have 1850,000. So this will give us the transfer value, which will be, we take 18,500,000, we minus 247,000, we minus 52,000, and we minus 1850,000, which gives us 16,351,000. Then we just need to now get the adjusted costs. So we'll have adjusted costs. So adjusted costs are all the other costs incurred while purchasing, after purchasing minus capital allowance. So we start from the top. Shebe Abdallah disposed the property. For that, he put up a hotel building at a cost of 9,800,000. That is now the cost of building. Another adjusted cost. Construction cost now. Cost of building, which we have 9,800,000. Then after that, and was completed in 2008. A local politician laid claim to the property in 2011. Shebe Abdallah filed a lawsuit suit against and won, having spent a legal charge of amounting to 3,450 on the case. So we have another legal cost on suit, which we have 3,400,000. The last one I have added instead of deducting, so I'll repeat. 1,300 plus 650 plus 13 plus 98 plus 3,450, then minus 740, minus, the last one is minus, so 14, we have 14,473,000. Now with that one we can get the capital gain. Capital gain, we had said you take the transfer value minus the adjusted cost. So you'll have 16,351,000 minus 14,473 GT1. So here that is number one. Number two, the form is CGT1. So that is how we deal with the capital gain and also the capital gain tax. So that marks the end of that lesson. I hope to see you in the next lesson. Thank you very much.
Hi candidates, welcome to another session of Manifested Online Classes. We are still continuing with the topic of group account, and in this session I want us to look on another concept of group accounts, and the concept is changes in group structure or disposal of interest. So when we talk about the disposal of interest, or basically changes in group structure, this whereby the parent company will sell all the shares held in a subsidiary, or basically sell part of the shares and retain some of the shares held in such what? a subsidiary. So therefore, what we're going to do here is we're going to look on how to prepare the group account whenever there is changes in the group structure, or basically we have now the disposal of of interest. But before we even do that, we can have an introduction to this, and we say that changes in group structure occurs when the parent company sells the whole or part of shares, whole or part of shareholding in the subsidiary company. Company. So basically that's what we refer as the disposal of interest. So the parent company here will sell some of the shares, or basically all the shares which are held in a subsidiary company. Now generally the disposal of interest can be broadly classified into two main categories. First of all, we have what we refer as a full disposal. A full disposal is whereby the parent company sells all the shares which are held in a subsidiary. That is a full disposal. But on the other hand, we have a partial disposal whereby the parent company sells some of the shares held in a subsidiary and retain some of the shares. So therefore here we can talk of types of disposal of interest, So when we say there are two types of this, we say disposal of interest basically is determined when the parent company loses control. So therefore you can say according to IFRS 3, International Financial Reporting Standard number 3, disposal of interest occurs when the parent company loses control. The parent company loses control. So basically what that means is that the shares now which are retained by the parent company, the subsidiary, or basically the parent company will sell some of the shares and retain shares which are less than 51%. So that is the time the disposal take place. And in such a case, then we are saying the parent company should proceed and determine the gain or the loss on disposal. What is important therefore to note as far as that point is concerned is that if the parent company has retained a control, when talk about retaining a control, this whereby we can be told A Limited which held 80% of the ordinary shares issued by B, the parent company we can be told like sold like 20% of the shares. 20% of the shares. What does that mean? It means that the parent company has retained 60% of the shares in what? In B. In such a case, you can see the parent company still having a control, because we said a company or an investor company will have a control of the investee, whereby the shares held by the investor company, the investee company, lies between 51% to 100%. So, but you're saying disposal in accordance with IFRS 3 occurs anytime the parent company loses control. It sells some of the shares here and retain shares which are now less than 51%, from 50% to 0. In which case we are saying a gain or a loss on disposal should be what? Should be determined. And therefore you can say when disposal of interest occurs, that is when the parent company loses control, parent company loses control. A gain or loss on disposal should be computed or should be determined, we can say should be determined as follows. So how do we compute that particular gain or loss on disposal of interest? So gain or loss on disposal of interest. Disposal of interest. So to determine this gain or loss on disposal of interest, number one, we take the fair value of purchase consideration received. Purchase consideration received. So when the parent company sold some of the shares, or basically all the shares in a subsidiary, how much amount was received by the parent company? So that is now what we refer as the fair value of purchase consideration received. To this, we add the fair value of investment which has been retained. Fair value of investment which has been retained. When talk about the fair value of the investment which has been retained, so this basically applies in case of a partial disposal whereby the parent company has not sold all the shares in a subsidiary. If, for example, the A Limited, which is the parent, which initially had acquired 80% share also, and then to this we also add the parent company and impaired goodwill. The parent company and impaired goodwill. And after deducting those two figures, we can get a positive figure here. If a positive figure, that is a gain, but if a negative figure, this is a loss on disposal. A loss on disposal. Yes, so this is basically how the gain or loss on disposal is determined anytime the parent company has lost the control. The parent company sells some of the shares held in a subsidiary, and therefore it retains shares which are less than 51%, from 50% to 0. Always in such a case we compute the gain or loss on what? The gain or loss on disposal. So then next we can proceed and look on how we prepare the consolidated financial statement anytime we have changes in the group structure. So let's look on the preparation of group accounts. So in this case, we're going to look on how we prepare the group accounts at different types of disposal. So remember, you have said that disposal of interest can be broadly classified into two: partial disposal and the full what? Disposal. Let's start with the full disposal. The full disposal. A full disposal generally is whereby the parent company sells all the shares held in a subsidiary. Sells all the shares held in a subsidiary. Maybe first of all, you can say that this is a whole what? Disposal, or basically a whole sale of shares in a subsidiary. So a wholesale of shares in a subsidiary company. And this one is basically governed by IFRS 5. So basically, in terms of how the parent company should treat that particular subsidiary which has been free disposed, that should be accounted for in accordance with IFRS 5, meaning that that subsidiary now will be termed, or basically will be referred to as a discontinued operation. Assuming we are told A Limited had acquired 80% shareholding in B Limited, and the parent company sells all these shares. So if that is the case, then this particular subsidiary is a discontinued operation, and should be accounted for in accordance with what? In accordance with IFRS 5. So what IFRS 5 requires is that the parent company should, number one, determine the gain or loss on disposal, and number two, the parent company should determine the gain or loss reported by that discontinued operation, and that one should be recognized, or those two items, the gain or loss on disposal of interest, the gain, the profit or loss from the discontinued operation, they should be recognized as separate items in the consolidated income statement. So therefore, we can say in this case, the parent entity or basically company should determine, or in other terms determine, number one, the gain or loss on disposal, the gain or loss on disposal of interest, and number two, the profit or loss from discontinued operation, from, we can abbreviate this as DO, from discontinued operation, and you are saying that these two items, that is the gain or loss on disposal and the consolidated income statement, the consolidated income statement, or the consolidated statement of profit or loss. So the parent company should first of all determine the profit or loss from the continuing operations. So the continuing operations will be the parent company and the NC, because you have said this one is a discontinued operation. So therefore, the parent company should determine what? The profit or the loss from continuing operations. Continuing operations include A and C, and for the parent company to do that, basically, in this case, we take the revenue of this continued operation. So how do we determine this profit or loss from discontinued operation? So we take the revenue of this company. For example, the parent company sold the shares held in B Limited, for example, 6 months from the start of the current financial year. So in that case, you take the revenue of B for the first 6 months, and also its expenses for the first 6 months, and then determine the profit or even the loss which was reported by that subsidiary B, which was fully disposed. You'll get the profit or loss from the discontinued operation. So if it's a profit, you add. If it's a loss, we do what? We less here. We less. And then we add that now to the profit disposed and not included in consolidated statement of financial position. So the assets and liabilities of that subsidiary will not be included in the consolidated statement of financial position. And equally, as far as that subsidiary is concerned, there will be no NCI. The minority shareholders will not be entitled to share the net asset of that subsidiary as at the end of what? Of there. That's basically how we deal with what you refer as a full disposal. Then from there we have the other type of disposal. Recall in our case here we have said that we have two types of disposal: the full disposal and the partial disposal. Partial disposal. Now here we have different types of partial disposal. Actually, we can say we have different scenarios of partial disposal. Number one, or number A, we have what we refer as a disposal of a company which was initially a subsidiary and which still remains a subsidiary. which still remain what? A subsidiary company to a subsidiary. So when talk about a subsidiary to a subsidiary, this whereby we can be told the parent company had like 80% shareholding in B Limited, and the parent company, for example, sold 20% of the shares. So if it sold 20% of the shares, then it means that the parent company, this one is not computed, because you have said we only compute that one anytime the parent company loses what? Control. So we can say no gain or loss on disposal of interest. On disposal of interest. Disposal of interest. So that is it about that scenario of partial disposal. So the other type of partial disposal, part B, is a disposal which makes a company which was initially a subsidiary to be maybe on 1st of July 2023, the parent company sold or disposed 40% or half of these shares. So mean that the parent company sold 40, and that means that the parent company then retained 40%. Retained 40%. So if it retained 40%, then it means that this company, which was initially a subsidiary, then becomes what? An associate. Becomes an associate. And therefore, in the first 6 months, the parent company, you can see, had 80% shareholding, meaning that this company was therefore a subsidiary. And then after selling half, the parent company retained 40%, meaning that in the last 6 months, that company was what? Was an date of disposal, up to date of disposal. Like in this case, in preparing the consolidated income statement, you're going to take into account the revenue and expenses of B for the first 6 months when it was a subsidiary. And then in the last 6 months, because it was an associate, you have to recall that we don't include the revenue and expenses of associate in the consolidated income statement. So that's why we are saying consolidate it results up to the date of disposal, and thereafter include group share of its profit after tax, and that is in accordance with equity method. That is in accordance with IS 28, because as far as the associate is concerned, we include, or what we include in the consolidated income statement is the group share or the parent company share of its profit after tax. So mean that you'll take the profit after tax of this company here, which is always given in its income statement, multiply that with 6 all over 12, so that you get now the profit after tax for the last 6 months when it was an associate, and then multiply that with the parent company shareholding in B, which is 40%. So that's basically how we prepare that. And then how do we prepare the consolidated statement of financial position? Consolidated statement of financial position. So in preparing the consolidated statement of financial position, our interest is basically the status of this company at the end of the year. So what will be the status of the investee company at the end of the year? At the end of the year, the investee company, that is B, will be an associate, and therefore in accordance with the equity method, what we include in the consolidated statement of financial position as far as the associate is concerned is something called the investment in associate. We don't include, or we don't combine, the asset and liabilities of the parent, those of the associate, in preparing the consolidated statement of financial position. So therefore, in preparing this, we say compute the investment in associate, investment in associate or joint arrangement, and included included in consolidated statement of financial position as a non-current asset. Always be provided to you. So you'll be told that the investment which has been retained on the date of disposal had this fair value. That's what you use here. And then to this we add the group share of post-acquisition net assets. Post-acquisition net assets. And whatever you get here is now what you refer to as the investment in associate, investment in joint arrangement, and you're saying that that should be taken to the consolidated statement of financial position as one of the item of the non-current what asset. Yes. So basically those are in the previous sessions that an investor or basically the parent company acquires a control over the investee once the parent company acquires shares which lies between 51% to 100%. So therefore a piecemeal acquisition is whereby the controlling interest in the investee company will be acquired through several successive purchase of shares. So therefore we can say that this is where the parent entity or the parent company, which is now the investor, acquires a controlling interest in the investee company through several successive acquired an additional 40% shareholding in B Limited. So what that means is that on this particular date here, when the parent company acquired the additional 40% shareholding, then the parent company acquired the control, because you can see the shares which are held by A in B lies between 51% to 100%, because we said a company will only be exercising control over the investee company whereby the shares held in the investee company lies between 51% and 100%. So mean that on this particular date, that is on 1st January 2020, when the parent company or A Limited acquired 20% of the shares in B, A Limited was not able to exercise control. So control or A will only be able to exercise different scenarios of piecemeal acquisition. So we can say there are several scenario of piecemeal acquisition. So number one, we have a mere investment. So when we talk about a mere investment, this whereby the investor company or the investor has acquired shares which are less than 20% of the shares issued by the investee company. So that is a mere investment. So we have an investment which was merely or which was purely a mere investment to what you refer as a associate. Basically, associate is a company or basically is an entity over which the investor company has a shareholding which lies between 20% to 49%. So this is the first scenario of a piecemeal acquisition. We also have a mere investment to a subsidiary company. So mean that the parent company initially had acquired shares which were less than 20%, and then later on the parent company acquired additional shares, meaning that the investee company now became a subsidiary. And then the other scenario of a piecemeal acquisition is whereby the investee company initially was an associate. The parent company had acquired shares lying between 20% to 49%, and then later on the parent company acquired additional shares, thereby acquiring a controlling interest over the investee company. So therefore these are the three different scenarios of piecemeal or the stage acquisition. Now, it is important for you to know how to prepare the group account in case of piecemeal or basically stage acquisition. And as far as the piecemeal or the stage acquisition is concerned, there are three points which are very, very important here. Let me mention them here. Three key important points. Number one, acquisition is computed on the date the parent company acquires a controlling interest. For example, using this small example which I've given here, if the parent company initially had acquired, or A Limited had acquired 20% shareholding in B on 1st January 2020, and then on 1st July 2023, A Limited acquired additional 40% shareholding in B. This is the date now the parent company acquired the control, and that is the date when the goodwill should be computed. Now, how do we compute this particular goodwill arising in a piecemeal or a stage acquisition? So let's look on how additional investment. So what do you mean by additional investment? Additional investment are the additional shares which have been acquired by the parent company. If the parent company initially had acquired 20% shareholding in the investee company, and later on the parent company acquired additional 40%, so there is the amount which was paid by the parent company in acquiring the additional 40% of the shares issued by the investee company. That's what we refer as the cost of additional investment. And then to this we add the fair value of original investment. The fair value of original investment. So on this particular date, when the parent company acquires a controlling interest over the investee company, the original investment, which is now the 20% shareholding, will have to be revalued to its fair value, and always that figure will be given to will be provided. Figure you have up there. If you're using the partial goodwill method, you have now to multiply that with the parent company shareholding in the subsidiary. Like in this case, you multiply that with 60%. So you less that from the figure which we have there, and that's how we compute now the goodwill arising from piecemeal acquisition. So therefore, this is one of the points which is very, very important, specifically when doing a question for group accounts, and we have a concept of the piecemeal or stage acquisition. So the other point which is also important here, point number 2, is that if or when preparing the consolidated income statement or the group income statement, the status of the company during the year, will determine how you are going to prepare the group account, or how you are going to take into account the result of that particular subsidiary. Like in this case, using this small illustration which I've given here, assuming we are required to prepare the group account or the consolidated financial statement for the year which ended 31st of December 2023. 31st of December 2023, meaning that the year started on 1st of January 2023, and you can see the parent company acquired the control over B on which date? 1st July 2023. 1st July 2023. That is the date A Limited acquired a controlling interest over B. So meaning, in the first 6 months here, because you have 6 months, in the first 6 months, A Limited had a 20% shareholding in B, had revenue and expenses purely for the last 6 months. You combine with those of the parent. You add them together with those of the parent. That's why we have said here, number 2, that the status of investment, so of which when talk about the status of investment, we are basically referring to whether this company was maybe an associate, was it a joint arrangement, was it a subsidiary. This is basically what you check, whether that company was as an associate, a joint arrangement, or a subsidiary. So the status of investment during the year, determines how to prepare the consolidated, of profit or loss. How to prepare a consolidated statement of profit or loss. So the other point, number 3, is that when preparing now the consolidated statement of financial position, you check the status of the investee company at the end of the year. For example, in our case here, B Limited at the end of the year will be a subsidiary. Will be what? A subsidiary. That is now what is important when preparing the consolidated statement of a financial position. So what that means is that because now this one at the end of the day will be a subsidiary, then you prepare the consolidated statement of financial position by adding similar items of asset and liabilities of A and those of what? Of B. So therefore you can say that the status of investment in the investee company determines how to prepare the consolidated, how to prepare the similar items of asset and liabilities of the parent, those of the joint arrangement, or those of the associate. But rather what you're going to include here in the consolidated statement of financial position is something known as the investment in associate or the investment in joint arrangement. So we can say here investment in associate or joint arrangement is computed and included in consolidated statement of financial position as a non-current asset. As a non-current asset, and which will be included in the consolidated statement of financial position if the investee company at the end of the year will be an associate or basically will be a joint arrangement. So therefore these 3 points here are very, very important, specifically when dealing with a scenario of a piecemeal acquisition or the stage acquisition. So we have seen, number 1, the goodwill is always computed by the parent company on the or actually goodwill on acquisition is computed on the date the parent company acquires a controlling interest, and basically this is how we compute the same. Number 2, we have seen that the status of the investee company during the current year, because you have said, you may see that during in the first 6 months the investee company was an associate, it was a joint arrangement, or basically it was a mere investment, and then in the last 6 months it was a subsidiary. So the status of the investee company during the current year basically determines how you prepare the consolidated statement of profit or loss. And that's why it's always important that once you come across a question for piecemeal acquisition, you come associate or basically joint arrangement or the group share of the post-acquisition net assets. So you add the 2, and then whatever you get there is the investment in associate or investment in joint arrangement, and that is a figure now to be taken into account in, or to be included in, the consolidated statement of financial position. So basically that's what you need to know as far as the piecemeal acquisition is concerned. So we stop at that point. Once we come back in our next session, we are going to look on an illustration question regarding how to prepare the group account in case of a piecemeal acquisition. So see you in the next session. Hi candidates, welcome to another session of manifested online classes. We are still soldiering on with the topic of group account. In this session, I want us to look on another concept that is preparation of a group account, specifically whereby the parent company has invested in an associate or in a joint arrangement or basically a joint venture. So remember, in our previous sessions, we have looked on how the group accounts are prepared, specifically whereby the parent company has invested in a subsidiary. And actually, we say the subsidiary is a company or is an entity over which the parent company is having a control, having a shareholding lying between 51% to 100%. So in this session, I want us to look on how to prepare the group account specifically whereby the parent company has invested in an associate or a joint venture. And actually, the preparation of those consolidated financial statements is governed by this particular standard here, that is International Accounting Standard number 28. Now, this standard here, International Accounting Standard number 28, prescribes how to prepare the group account or how to prepare the consolidated financial statement, specifically whereby the parent company has invested in an associate or a joint venture. So therefore, we can say here as an introduction that International Accounting Standard number 28 prescribes the accounting for the or an entity in which the parent entity, the parent company. Remember, the parent company can also be referred to as the investor. The parent company or the investor exercises significant influence. Exercises significant what? Influence. So what do you mean by significant influence? When talk about significant influence, this is the power by the parent company or the power by the investor to participate in making financial and operating decisions of this company, which is called the associate. So once the parent company has invested in an associate, the parent company has the powers to participate in making the financial and operating decisions and not controlling those particular decisions, decisions. So therefore, that is the other term we can define. That is the term significant influence. Significant influence, where we say that this is the power to participate in making financial and operating decisions, the part to participate in making financial and operating decisions of the associate and not control. B, but A Limited cannot control those operating and financial decisions which will be made by B Limited. So therefore, this company here is an associate. Is what? Is an associate. Is an associate. So the other term maybe we can define here is a joint arrangement. A joint arrangement. So in this case, when we talk about the joint arrangement, we say this that this is an arrangement. This is an arrangement. An arrangement to exercise joint control. To exercise joint control. So when talk about arrangement to exercise joint control, this whereby two entities, say A Limited and B Limited, these two entities acquires equal shareholding, 50% shareholding in a company maybe which is to be called or which is called J Limited. So what that means is because A Limited and B Limited have acquired equal shareholding in J, then the operating and financial decisions which will be made by J Limited cannot either be controlled by A Limited or arrangement are accounted for in accordance with what? In accordance with International Financial Reporting Standard number 11. We are going to later on maybe mention something to do with that particular standard. But in this case, we have two types of a joint arrangement. Number one, we have a joint venture. We have a joint venture, and number two, we have something called a joint operation. A joint operation. So you may come across a question in an exam setup whereby the examiner is requiring you to highlight or maybe to explain two types, or just to mention two types of the joint what? The joint arrangement. So therefore, these are basically some of the terms using equity method. When the parent company is preparing the group account or the consolidated financial statement, investment in associate, investment in joint arrangement should be accounted for using the equity method. So what does this method then prescribes, or basically what does it say regarding how to account for investment in associate, investment in joint arrangement? So we can say that equity method, equity methods requires investment in associate and joint arrangement to be initially recognized in consolidated statement of financial position at a cost, and subsequently adjusted with a group share of post-acquisition retained earnings. Post-acquisition retained what? Earnings. What does that mean? It means that in preparing specifically the consolidated statement of financial position, what should be recognized there as far as the investment in associate or investment in joint arrangement is concerned is something called the investment in associate, investment in joint arrangement. And actually, it should initially be recognized in the consolidated statement and other comprehensive incomes. Other comprehensive incomes, abbreviated as OCI, should be included in consolidated income statement. Should be included in the consolidated income statement. What does that mean? It means that in preparing a consolidated income statement, where the parent company has invested in an associate or a joint arrangement, the parent company should not include the revenue and expenses of the associate or that of the joint arrangement, but what should be included there in the consolidated income statement is the group share, or in other terms, the parent company share of the joint arrangement or the associate, profit after tax, and other comprehensive income, other comprehensive income. I think we can expound these 2 points further. We can expound these 2 points further so that you can be able to understand. So let's expound them by looking on how we prepare the consolidated income statement, whereby the parent company has invested in associate and a joint arrangement. So which you're saying that this should be prepared, the consolidated income statement should be prepared in accordance with the International Accounting Standard number 28. That is using the equity method. So number one, as far as the associate or joint arrangement is concerned, is the group share. The group share of associate or joint arrangement profit after tax is included as part of other incomes. Is included as part of other income. So what we include here in the consolidated income statement as far as the associate or joint arrangement is concerned is the group share, the parent company share of the associate or joint arrangement profit after tax. We include it as part of other incomes, as part of other incomes, as part of other incomes. Being part of other incomes means that we add it to the gross profit. We add it to the gross what? Profit. Also, the group share of associate or income in the group income statement. So then let's proceed and look on how we prepare the consolidated statement of financial position. Consolidated statement of financial position. So these are some of the key points to note. Number one, that associate and joint arrangement assets and liabilities, assets and liabilities are not included in consolidated statement of financial position. Very, very important that the assets, the liabilities of the associate asset, non-current asset. So how do we compute that investment in associate or investment in joint arrangement? So let's look on the computation of the same. Investment in associate or joint arrangement. So this one is computed as follows. Number one, we take the cost of investment. The cost of investment. The cost of investment, this one, is the purchase consideration paid by the parent company in acquiring shares of associate or shares impaired with a certain amount. So you less it here, you less it here. So whatever you get here is now what we refer as the investment in associate, investment in joint arrangement, and we are saying that this one is then the only item which is included in the consolidated statement of financial position, consolidated statement of financial position, as far as the associate or joint arrangement is what is concerned. So therefore, what we have discussed here, there are some key points which you need to remember. That number one, whenever the parent company has invested in an associate, and basically you have to recall, we have said that an associate is basically a company or is an entity over which the parent company has acquired shares, which lies between 20% to 49%. According to the equity method, when the parent company is preparing the consolidated statement of financial position, assets and liabilities of the associate or those of the joint arrangement should not be included there. What the parent company should do is to compute this particular item here, which is called investment in associate or investment in joint arrangement, and this should be included in the consolidated statement of financial position as an item of what? Non-current what? Asset. And basically that's how we compute the same. So basically that's what you need to know. I want us we stop at that point for now. Once we come back in our next session, I want us to look on an illustration regarding how to prepare the consolidated financial statement whereby the parent company has invested in an associate or a joint arrangement. So see you in the next session. Hi candidates, welcome to another session of Manifested Online classes. We are still continuing the topic of group accounts. In this session, I want us to look on an illustration question regarding how to prepare a consolidated statement of comprehensive income, or basically a consolidated income statement. Remember, in our previous session, we have looked on how to prepare the same, and also we discussed on the various consolidation adjustments which are necessary in preparing a consolidated income statement. So let's go through the illustration. We see what we are told and equally what was required. So we are told C Limited acquired 80% investment in S Limited on 1st of April 2023. The statement of profit or loss and other comprehensive income for two entities for the year which ended 31st of December 2023 are presented below. So we have the statement of profit or loss and other comprehensive income for the year which ended 31st of December 2023 for C Limited and S Limited. We have revenue, cost of sales, gross profit, distribution and administrative expenses, a profit before tax, income tax expense, profit for the year, other comprehensive income which include the gain on revaluation of a property, and then we have the total comprehensive income for the year. We have some additional information about you're told a goodwill of shillings 100,000 arose on acquisition. An impairment review conducted as at 31st of December 2023. That is, an impairment review was conducted on 31st of December 2023, and it was decided that a goodwill on acquisition of S was impaired by 10%. Number two, we are told that on 31st of December 2020, that is 31st of October 2023, S Limited sold goods to C for shillings 300,000. 2/3 of these goods remained in S Limited inventory at the year end. And then you're told S Limited charges a markup of 25% on the cost. And then number three, we are told assume the profit and other comprehensive income of S Limited accrued evenly over the year. Number four, we are told at the date of acquisition, the fair value of S Limited net asset approximated the carrying amount with an exception of plant whose fair value exceeded its carrying amount by 100,000. And then you're told the plant had a remaining useful life of 10 years. So what are we required? We're required to prepare a consolidated statement of profit or loss and other comprehensive income for the for C group for the year which ended 31st of December 2023. So basically, this is a question for group account whereby we are required to prepare a consolidated statement of profit or loss and other comprehensive income. Remember, what we said is that anytime you come across a question for group account, the first thing you need to do is basically to come up with a group structure that will help you to know which company is the parent, which company is the subsidiary, and also from there you can do various workings which will help you in terms of preparing what you're required to do. So therefore, the first thing we need to do here is to come up with a group structure which will be our working number one. Working number one, we come up with a group structure. So where do we get that particular information? In the first paragraph, whereby we are told C Limited acquired 80% investment in the company which is called S Limited. On which date? On 1st of April 2023. So 1st of April 2023, this is what we refer to as the date of acquisition, the date of acquisition. So when preparing the consolidated income statement, it's very, very important for you to identify two dates. The date of acquisition, which we already have there, date of acquisition, which is the 1st of April 2023. And then you also need to have the date of consolidation. So when talk about the date of consolidation, this is the date you are required to prepare the consolidated statement of profit or loss. If you go to the requirement, we're required to prepare our consolidated statement of a profit or loss on 31st December 2023. 31st of December 2023. So having identified those particular two dates, you then need to identify, or basically you need to check whether this particular subsidiary was acquired during the current financial year. So you can see the current financial year is ending on 31st of December 2023. It automatically means that that year started on 1st of January 2023. That is when the year started. But when was our subsidiary acquired? That is S. It was acquired on 1st of April 2023. These are some few months to the end of the year. So in other terms, we can say that this particular subsidiary was acquired during the current financial year, in fact 9 months to the end of the year, because if you count from April to December, those should be 9 months, because here we don't have January, February, and March. So meaning that we have 9 months, and therefore take into account this particular subsidiary was acquired during the current financial year and actually 9 months to the end of the year. Then we have said in preparing a consolidated income statement, we only take into account the revenue and expenses of this subsidiary from the date it was acquired to the date of consolidation. We are going to take into account the revenue and expenses of S only for 9 months. Only for 9 months. Actually, we are going to apportion that on time basis, and that's why we are given note number 3, or the information in note number 3 is what is important. So therefore, this is our group structure. So from this group additional information, before we prepare what is required, I think we need to do some few workings. In note number 1, you are told goodwill of shillings 100,000 arose from acquisition. So in this case, when preparing the consolidated income statement, we don't take into account the goodwill there, because goodwill we know is an asset. So what we take into account here is any impairment loss. And that's why you can see in the other sentence of note 1, you're told an impairment review conducted at the end of the year, or an impairment review was conducted at the end of the year, and it was decided that the goodwill on acquisition of S was 10% impaired. So the reason why given that particular information is for us to be able to compute the impairment loss. Impairment loss on goodwill. Impairment loss on what? On goodwill, which would be equal to 10% of the impairment loss of the goodwill. So 10% of the value of the goodwill, which is 100,000, and this will be 10,000. And recall what you have said in our previous session, that this one is supposed to be included as part of administrative expenses. And then we go to note number 2, whereby we are told that on 31st of this October 2023, these are like 2 months to the end of the financial year, S Limited, which is now our subsidiary, sold some goods to C, which is the parent, for shillings 300,000. So what is that? So this is now what we refer to as intra-group trading. Intra-group trading. Intra-group trading. Sales between the group members, and in this case is also important to note that these were sales by our subsidiary, that is S Limited, to C. So the goods which were sold by our subsidiary, that is S Limited, to C, they had a value of 300,000, and also our figures which are given in the statement of profit or loss are in thousands of shillings. So when taking any figure from the additional information, also recall to omit the last 3 zeros. In fact, this will also apply here. That figure we're going to take it as 10,000. So this particular amount of intra-group trading, from what we have discussed in our previous session, this one we are going to deduct it from the group revenue. From the group revenue. So once we add the revenue of the parent and the subsidiary, we less 300, and also we less it from the group cost of sales. From the group cost of sales. That's what you have said. And then you're told in the same point, 2/3 of these goods remained in C Limited inventories at the end of the year. At the end of the year. So anytime you come across that particular information, that some of the goods remained in the inventory of the purchasing or buying company, it automatically means that some of the profit which was reported by this company was not yet realized. And therefore, what you need to do is to compute the unrealized profit on inventory. It's also important to note that this unrealized profit always is by the selling company. The selling company is S. So how do we compute the unrealized profit? You have to recall the formula. So we take the unsold goods times the gross profit margin. Times the gross profit margin. So we are told the goods which were not yet sold were 2/3. 2/3 of what? 2/3 of the sales by S to C. so which is 300,000. So this will give us the unsold goods times the gross profit margin. So in the last sentence of note number 2, we are told S Limited charges a markup of 25%. So what do we need here is the gross profit margin. Are we given the gross profit margin? No. So what we are given here is the gross profit markup. A gross profit markup, which you are told is 25%, which is the same with a quarter. And actually recall what we have already discussed in our previous sessions, that if you're given a gross profit markup, you use that to compute the gross profit margin. So the gross profit margin here will be 1/4, and then to the denominator we add the numerator, so which will be 1/5. So number 4, we are told point number 3, assume the profit and losses, that is a profit, another comprehensive income of S accrued evenly throughout the year. That information you are going to use it in preparing the consolidated statement of profit or loss, whereby you are going to take into account the revenue and expenses of this for 9 months all over 12. That's why that information is given. And then number 4, that is number 4, we are told at the date of acquisition, at the date this subsidiary was acquired, the fair value of S Limited net asset approximated the carrying amount with an exemption of an item of plant whose fair value exceeded its carrying amount by 100,000. So basically that is what we refer as the fair value adjustments. Fair value adjustment. So all the fair value exercise. So remember we said fair value exercise in our previous sessions, that this is a process through which the subsidiary company revalue its asset on the date of acquisition. And because the subsidiary company do not account for that revaluation of assets, then here we said in preparing the consolidated income statement, there is something we need to do here, and that is to determine the depreciation overcharge or what? Other charge, as far as the revaluation of asset by the subsidiary company is concerned. So we are told, with an exception of an item of plant whose fair value exceeded the carrying amount with an amount of 100,000, and the date of consolidation, date of acquisition, date of consolidation. Between the date of acquisition to the date of consolidation, in our case we have 9 months out of 12. So this will give us the depreciation other charge for the current financial year. So which will give us 10, or actually that will give us what? That will give us 90 divided by 12. So which will give us 7.5. 7.5. So this particular depreciation other charge, we said unless told otherwise, also added to the group. We also added to the group cost of sales. To the group cost of what? Of our sales. And I think in our case we are done with the workings.